Good afternoon, everyone. Welcome to our December webinar for the Brady Ware Dealership Advisors Group. Normally, this is always one of our annual ones where we do an annual review and some year-end housekeeping reminders and things like that from the past year. And it's been a heck of a ride for everyone. It's been an interesting year to say the least. And Tom Wolf of our group is going to give his annual update and some housekeeping reminders and things related to the pandemic. So with that, I'll turn it over to Tom.
Thank you, Sam. I appreciate it. Appreciate everyone joining the webinar today. Like Sam said, 2020 has been a year like any other. So we're going to cover some things that we've covered for a couple years, some good reminders for year end. This year's kind of flown by and we're already here almost the middle of December. So there's going to be some good things to cover for year end. Some things that are new that are a result of the pandemic and COVID and some of the adjustments we've had to make this year. So there'll be some new things that we'll cover, some good reminders to make sure things are in good working order and your house is in good order here before the end of the year. So with that, let's go ahead and jump in and take a quick look at today's agenda. So we are going to be talking about accounting records, tax planning, some tax reporting and compliance, everyone's favorite, I'm sure. And like I said before, just as an addition, we're going to look at pandemic planning and some things you can do there as we're getting towards the end of the year. I'm sure people are really looking at their PPP loans and what to do there. So we'll talk a little bit about that at a high level. So just to let you know, that'll be covered in that section as well. So lots to cover today. So let's go ahead and jump right into accounting records. So, apologize there. All right, so bank reconciliations, unclaimed funds. Just making sure here that you've got your unclaimed funds returns, even if you don't have any checks that are to individuals that are greater than a year old. Number one, you should be working to try to resolve that with the individuals, track them down, find addresses, void those checks, get them reissued. But if you can't do it, then technically the state of Ohio will ask you to remit those funds that are aged to individuals greater than a year. If you have outstanding checks to businesses, if you can't track down the businesses and can't get them to cash your check, then you can go ahead and take that in income. But for individuals, those would need to be submitted to the state of Ohio for them to hold on to that money for you until the individual can be tracked down. So as you're doing your bank reconciliations, take a look at your outstanding checks that are to individuals, making sure that even if you don't have any, getting an unclaimed return filed with a zero balance due is best practice there. Take a look at your receivables. Hopefully you don't have any contracts in transit or anything like that that's aged out there. Look at employee receivables too. That's the number one thing when I go into dealerships and take a look at the receivables. I want to make sure if you got employee receivables, there's a good plan to get those collected, that we're collecting those through payroll. Also, in terms of employees, want to take a look at your work in process report. Make sure you don't have any repair orders out there that are going to turn into employee receivables that have been hanging out there and could cause an issue down the road. Employee leaves, they've got an open work order, they've gotten work done on their personal vehicle. So taking a look at all your receivables at year end, especially the employee receivables, to make sure there's no write-offs due there. If you do need to do some write-offs, it's a good idea to make sure you keep track of that detail. Rebates are another area that are typically get some aged items out there and can be difficult to collect sometimes with all the different factory programs. We can write off those amounts while still keeping the detail on the schedule, so we continue to track those down, work with the F&I manager and the sales managers to track those rebates and get those paid. But if you need to reserve for them at the end of the year, as they may be uncollectible, that's a good way to do it and keep them on the schedule, so we still try to chase down that cash. Those rebates can be significant. Your finance chargebacks are another big area, depending on the lending relationships you have with your bank. Those can be significant. If they are significant, hopefully you're recomputing those on a monthly basis as well. Sometimes the banks make mistakes in terms of the length of the contract or the reserve that was paid up front. So it's always good idea to recompute those chargebacks. But if there are significant chargebacks that come through On the January statement for December deals, we can accrue those and expense those in this year to make sure we're getting that full tax deduction for things that have happened for next year. Making sure to do a good physical inventory of your vehicles. Hopefully you don't have any cars missing. Not all the cars are on floor plans, so it's a good idea to do a physical count of all the vehicles. Make sure if you're having somebody outside the accounting department do it, that you give them basically a blank list for them to write down VIN numbers and stock numbers, then that gets compared to the accounting schedule for inventory. You're not just giving them an inventory schedule and they go through and say, oh yeah, I found all these cars. Give them a blank sheet of paper to put down that information, then we can trace it back to accounting and make sure we've accounted for all the vehicles. LIFO estimate, as I said before, that's required to be put in your final monthly statement for the year, which in most cases is December 31st. LIFO is going to be big this year, as most of our new vehicle dealers know. Manufacturers were on shutdown for a while. We ran low on inventory. We're starting to build back up. But if our inventory levels are down, excuse me, significantly from prior years, we could have some LIFO recapture depending on what this year's inflation is going to be on those vehicles compared to some of our previous LIFO layers. LIFO estimates are going to be even more important this year as we're doing our tax planning, which we'll get into in a few slides. But those LIFO estimates are going to be key to making sure that if we've got some recapture, that we plan for that, and we could have some additional taxes due here April 15th in 2021. Prepaids, these can become a dumping ground for 13th period adjustments. So we want to make sure we look at prepaid schedule, see what's really valid prepaid. If we've got some prepaid insurance or some advertising for next couple months, that's all well and good. But if we've got adjustments to gross that we didn't want to take throughout the year, let's make sure and get those cleaned up. So again, we have a good cutoff at the end of the year. Floor plan reconciliation, hopefully you're doing that on a monthly basis. At a minimum, you want to do it at 12/31. Again, for our LIFO, that could be down a bit this year with inventory levels being down. So what we are able to do, though, if we've got in-transit units on our floor plan reconciliation, in other words, cars that are on the statement that we have not yet received on our lot and booked into inventory, Chrysler's a big culprit here. They typically take a lot of time between when it hits your floor plan statement and when you actually receive the vehicles. We can include those in-transit units for our LIFO calculation at the end of the year. So you want to make sure and give your accountant that information as well. That every little bit is going to help. Moving on to fixed assets capitalization policy, we've got de minimis rules here for safe harbor that we can elect. If you have an audited financial statements, you can expense purchases up to $5,000. If you don't have an audit, anything below that, reviews, tax onlys, we can expense up to $2,500 of new purchases. If we have amounts that are above that, depending on your taxable income, we'll talk in a few minutes about what can be done there with depreciation. But in general, looking at your fixed assets, making sure we're expensing smaller dollar items to repairs and maintenance. Again, some things that may have been held out throughout the year to not affect the departmental profitability, we can go ahead and expense in December. And speaking of fixed assets, if you've got anything old, it's not a bad idea to go through and do a quick inventory of your fixed assets. If you've got a computer from 1982 or something like that, that's something's easy to dispose of and get rid of. And if there's any basis left, that can be deducted on your tax return as well. In terms of service and parts, I always recommend having an outside parts physical done by an independent firm. I think cycle counts are a great thing to do within the parts department throughout the year. But when we get to the end of the year, it's a great idea to have an independent firm come in and do that. So as you're planning for that, make sure you're counting your gas, oil, grease, looking at your work in process. Like I said, looking to see what repair orders are out there, making sure work in process is adjusted correctly and working correctly. And then if you have any special tools, that can be something that we either need to write down, make sure we're depreciating throughout the year, taking a regular inventory of those as well, just because those are easy things to get misplaced or possibly walk out of the dealership. So quick review of accounting records there. Moving on, just a couple more things. So demos, we want to make sure we write down our demos. We'll talk a little bit about demo policies here in the next couple of slides, but writing down those demos, obviously they're being used, their value is being diminished, so we want to make sure and write those down. Real estate taxes, another accrual that hopefully is being done via standard journal entry throughout the year, but making sure our real estate taxes are tied down. If you get the bill in January for next year's taxes and it's gone up, we can accrue that back in December as well. So keeping an eye out and adjusting December if we get some additional information in the beginning of the year. Ohio CAT taxes, those will be due mid-February, depending on how long you keep your books open. You want to make sure and get that accrued for. You should be able to do a quick calculation at the end of December with your sales, taking away your out-of-state sales and some other reconciling items to make sure you get a good CAT tax accrual for the end of the year. Always want to make sure you accrue the interest on your floor plan statement that's going to be due at the beginning of the year for the month of December. Year-end bonuses for employees, if you've got unit bonuses, salespeople bonuses, general manager bonuses, based upon net income, grosses, unit sales, whatever those may be, we want to make sure and get those accrued as of the end of the year. If we're going to be paying them out as late going into March as possible, we can pay those at that time, but still accrue them at the end of the year. So we want to make sure we keep an eye out for bonuses, anything that's additional going to be due at the end of the year. Employee vacation, depending on what your policy is, that can be accrued as well. We've got 2.5 months going out to March 15th, so that can be accrued for any of that vacation that's going to be used throughout those first couple months. Now, in terms of your shareholders or owners of the company, want to make sure that all rents and interest and wages are paid to them by the end of the year. They are not allowed to have accrued amounts for rent, interest, and wages at the end of the year and be deductible by the company. So those all actually need to be calculated and paid in order to get that deduction. So there's a little bit of a distinction there between the employees and the owners. Okay. Now moving on to some high-level tax planning. So when we do tax planning for our clients, we always want to look at looking at 2 years. What's happening this year? What's happening next year? Especially with the new tax law changes from a couple of years ago, it really made sense with the standard deduction changing. So looking at doing 2 years of tax planning, trying to manage if you're going to make a big purchase of something in the first quarter of 2021. Is there a way we can make that purchase, especially when it talks about bonus depreciation and equipment, that we can speed up that depreciation? So I was just talking to a client last week, if you're going to make a purchase in the first quarter of 21, and if at all possible, make that purchase now in order to get that depreciation deduction and speed up that deduction for the company. So looking out not only to this year, but next year. So bonus depreciation, there was a little bit of a limitation put on that with the Tax Act from a couple of years ago. That's been corrected now. So basically, as long as your adjusted taxable income, your floor plan interest doesn't exceed that 30% of your adjusted taxable income, you're able to take bonus depreciation. There's a special calculation to do, but high level, that's really what you need to consider and make sure that that's available. Bonus depreciation, there's no limitations on that. If there are limitations, though, if you have profit in your company, you still have Section 179 available to you as well. If bonus depreciation isn't going to work out because of floor plan interest being too high, you still have Section 179 available up to just over $1 million, and that doesn't start to phase out until you have $2.5 million worth of additions. So for most of our dealers, without significant construction, that's another option there as well. And with some of the changes to the Tax Act, that things got cleaned up a little bit. The qualified improvement property now qualifies for Section 179 and bonus depreciation where it didn't before. So a couple of things have been cleaned up there, more opportunities for these deductions, which is great news. The Section 199A, the 20% business deduction, again, this came in with the Tax Act a couple of years ago. Really just involves kind of fine tuning that planning, balancing the income of the company as well as wages for the owners. So that's a good calculation to start to do at the end of the year and project what those numbers are going to be to make sure you're taking full advantage of that 20% qualified business income deduction. Another change from a couple years ago with the Tax Act, the non-deductibility of entertainment expenses. You still have travel being 100% deductible. Meals and entertainment, meals are a lot of years of talking about meals and entertainment. Meals are still 50% deductible. Entertainment is no longer 50% deductible. It's not deductible at all. So it's important to make that segregation, and which hopefully you started doing over the last couple of years, breaking out travel versus meals versus entertainment in your general ledger, so you have that detail. It's an easy calculation as part of your tax return. So like I said, there's the standard deduction and really looking at how the tax planning looks for 2 years. Because of that, whether you're looking at charitable contributions, maybe bunching those together, because for most folks, the standard deduction really doesn't apply anymore, or actually does apply, you don't have the itemized deduction. So that's something to look at and make sure you're maximizing your deductions when you do make those charitable contributions or any other things that would be on your itemized deductions list. So that's why it says consider bunching those. So like I mentioned before, if you do have significant construction and you're looking at bonus depreciation in Section 179, a cost segregation is always a great investment to make for a couple $1,000s in order to get that study done to really maximize the depreciation, speed up the depreciation on the components of that new building is always worth it in terms of the time value of money. Some other things to look at here for tax planning: maximizing retirement plan contributions, whether it be your employer match at the end of the year, accruing that. Also, some cash balance plan options are good ideas. They're a good way for owners to maximize their contributions without really running the risk of having some compliance testing issues. So cash balance plans have become more popular lately as owners have looked to maximize those contributions, not only for the company, but for themselves, and really give them that flexibility. Some other things here: interest in advertising on new vehicles. I mentioned this before. You get paid on those vehicles when you buy them from the manufacturer, but for tax purposes, we can defer that income or recognizing that interest assistance and advertising assistance in income until we actually sell the vehicle. So it's kind of like a LIFO calculation at the end of the year. We do it once at the end of the year. That deferral takes that out of income for this year and defers that to next year when the vehicles are sold. Also, along the lines of inventory, used vehicle write-downs are a great tax planning opportunity, as long as you're not on used LIFO, which most folks aren't. So this is where you want to use vAuto or any other approved, most folks use vAuto, but any other approved official used car guide, price guide. Do your calculation as of the end of the year. We can record that reserve without affecting the cost of the vehicles that you have in inventory. Record a reserve in a separate account, give you that tax deduction for any water you might have in your used car inventory, and that changes every year. Again, it's like a one-time calculation a year per LIFO. So it's a really good tax planning opportunity for used cars. And like I mentioned before, with the LIFO, with the LIFO estimate, with lower inventory levels this year, we could have some significant recapture. So you really want to get with your accountant this time of year and say, here's my November inventory. Hopefully folks are getting ready to close now. Send off your statements, get those LIFO estimates done, so you really have a way to plan for that possible income recapture for LIFO, and see if there's any way to mitigate that. But it looks like for a lot of folks, there's going to be some recapture there with lower inventory levels in 2020. So it's really something you want to be out ahead of. And like I said, really when you talk about tax planning, it's really looking into 2 or 3 years out to making sure if there's anything that's coming down the road that you plan for those and consider that timing, what's happening this year, next year, and the year after that. Tax planning is all about timing and maximizing those opportunities, whether it be income or deductions. And like I said, this all comes together. A lot of dealers have had, even in spite of the pandemic, the ones that have been able to stay open have had fantastic years, record years in a lot of cases. So this year's income is going to be up. We could have some LIFO forgiveness adding on to that, or I'm sorry, LIFO recapture adding on to that, plus PPP forgiveness. And we'll talk about that in a few slides. That could really have a significant impact on 2020 taxable income. So there's lots of things to consider now that could affect what's due on April 15th. So just a few more things on tax compliance and reporting before we get to some of the issues for 2020 specifically in terms of PPP, COVID, and the pandemic. So a couple things here on tax compliance. Demo vehicles, we want to make sure you've got a written demo agreement with all your employees. There's 4 different ways that we can calculate that demo amount that we need to include on W-2s as a fringe benefit. 2 for salespeople and 2 for non-salespeople. So you want to make sure you're giving that calculation correct, making sure that any employer paid health insurance on behalf of the shareholders is included on their W-2s. so that they can include that in their tax return as well. Always a good time of year, especially maybe building up to November and December, looking at W-9s to make sure you've got all the information you need for 1099 reporting. Form 8300 is hopefully something that folks are doing on a regular basis, making sure that cash payments are accounted for, making sure that if you've got two separate payments that add up to more than $10,000 in cash, that those are being, tracked and reported at the proper time. I mentioned meals and entertainment and travel previously. Hopefully you've got a general ledger account that's set up separately to track those amounts to make sure that those are accounted for. And like I said, the deductibility of those is different. Sales and use tax, this is becoming a little bit more popular, especially in Ohio's use tax, not only on demos and free service loaners. That's been a huge area of focus for the state of Ohio. And so you want to make sure you're getting your sales tax filed on time, use tax, making sure to get that calculated and reported as well. If they see you've been filing sales tax and CAT tax returns over the past 10 years and you've never filed a use tax return, it's probably not a good thing. You're probably going to get selected to look at further. So use tax has been a hot button for the state of Ohio, especially recently. In terms of CAT tax that I mentioned previously, out-of-state sales, if you're not being charged sales tax, you need to report that as well. You do have a $1 million exemption. You want to make sure you're only taking that probably in the first quarter of the year and not taking that $1 million for every single quarter. So most dealers with their sales are going to go through that $1 million sales exemption in the first quarter of the year. We've seen issues before where people are taking that $1 million exemption for every quarter of the year, so it really becomes a $4 million exemption. So just be careful of that. So that kind of wraps up the tax compliance and reporting section here. So like I said, this year, really like any other, there's some new challenges that every business has. And so we're just going to touch on a few things high level here in terms of the pandemic. So PPP loan, a very hot issue right now. I'm not going to go into too much detail here. It really can vary depending on your individual circumstances. And so there's been a lot of questions about this recently. Most folks are aware that when this was done back in March, April, I think the government really intended for this loan forgiveness to be non-taxable, which the forgiveness itself as of right now is non-taxable. However, the IRS has come out and said, well, if you are reasonably confident that you will have PPP loan forgiveness, whether it be this year or next year when you do your application, the IRS is saying that you cannot deduct any of those mostly payroll expenses that were associated with that PPP loan. So that essentially makes it taxable anyway. So there's been a lot of lobbying going on, I'm sure by NADA as well, with all the different organizations that have sent this letter to the government and to their different government officials to try to lobby for this change, because this could have a significant impact on people's tax liabilities this year and their tax obligations. So hopefully that changes sometime here in the near future, but as of right now, whether you put in for your loan forgiveness application, as of right now, any of those expenses that you use to pay with the PPP loan proceeds would not be deductible. Now there's a stimulus package, another one being floated around. There's been some mention of the deductibility issue that maybe that gets cleaned up by Congress, but we shall see. So there's a lot hopefully gets explained in the next couple weeks here before we get to year end. But that's a really hot topic that we're continuing to monitor and continue to see how that plays out. So we'll keep you posted on that. That's a whole nother webinar probably. Another thing that probably a lot of employers, excuse me, have had to deal with already is when you have employees that are either sick or they've had to be quarantined because loved ones or family members have been affected by the virus. The Families First Coronavirus Response Act gives the employers ability to continue to pay those employees, keep them on the payroll, keep them with wages and benefits, even while they're under quarantine or out sick, and basically then reporting that as a separate payroll code. Most companies have outside payroll vendors now, and so I'm sure you've had to deal with that and tell the payroll company this is a person that is out for this reason. They put that under a separate payroll code. You then get those tax credits on your Form 941 that you file at the end of the quarter. So it's really making those companies whole for any employees that have had to be out for an extended period of time because of the coronavirus. So making sure that happens as well. So so really looking forward to COVID-19 recovery, and I think what the end of this year and what next year holds. I think what we've learned as I'm talking with my clients, what we've learned is tomorrow, you never know what can happen. When we were doing this year-end reminder last year, we had no clue what 2020 would entail for us. And like I said, a lot of dealers have had success throughout the year and have had some good times, but it can change at any moment. Inventory can run out. There could be a lot of changes. So I think it's important not to take for granted that that things are just going to continue as normal. I think we've shown that a lot of dealers have learned that there's different ways to sell cars and deliver cars and service vehicles. So I think our business models have changed overall. But nonetheless, I think just some good reminders as we go forward from here. Like I said, at the end of this year and into next year, have a plan. I think, depending on what mandates come down from the government, stay at home, business closures in some cases, have a plan as to how you deal with that, how you take care of employees working remotely, dealing with customers, digitally and not in person, signing contracts, that sort of thing. Have a plan, have a backup plan for whatever can change in the near future. And I think as well, financially, like I said, there's been a lot of good times, but you never know what could happen. And so it's important to have a strong balance sheet and make sure you've got cash and some resources and some reserves to get through some tough times. And I think that can be a huge thing for the businesses that are going to have challenges. You've got to be able to wait through those challenges and wait out the storm. So, and I think in some cases too, I've talked about this, is, we still have a lot of baby boomers out there that may be looking to retire, sell their dealership and retire. So there's opportunities out there. If you've got a strong balance sheet, if you feel like you're prepared for the future, this could be a time for new opportunities or expansion. There's still a fair amount of activity in the buy-sell area. So this could be, someone's just said, I've had enough, COVID's kind of the straw that broke the camel's back. Maybe this is a new opportunity to build the dealership group that you have and continue that on in the future. Well, that kind of wraps things up for the day. I appreciate everyone being in attendance. Here's my contact information. If you have any further questions, be happy to answer any of those and just reach out. So again, hopefully this was informative. We got a few days here before year end to tidy up some things. If you have any questions, let me know. But otherwise, good luck and stay healthy into the future, everyone.
Thank you, Tom. Great job. A lot of good information there. Like you can tell, it's been a fast but interesting year, to say the least. And it's good to have 2020 behind us here real soon. And hopefully things are in 2021 are a lot better. So with that kind of wraps up our webinar series for calendar year 2020. We'll be back in 2021 with hopefully a new set of good topics, and look forward to seeing everyone. Everyone have a good holiday season and a good healthy new year. Talk to you next year.
Thank you.